Everyone thinks stock growth is loud. Big headlines, breaking news, green candles exploding on a chart. But most life-changing stock moves don't start with noise. They start with silence. Right now, some stocks are quietly being positioned for major growth, while most people are looking the other way. And the uncomfortable truth is this: by the time growth becomes obvious, most of the money has already been made. That's why this topic matters right now. Not because markets are exciting, but because they're confusing, contradictory, and slightly dishonest. Let me tell you a short story. In early 2020, airlines looked cheap. Everyone could see the problem. Planes were empty. The risk was obvious. But at the same time, a handful of boring, almost invisible companies were quietly signing contracts, raising guidance, and locking in long-term revenue. No hype, no buzz, just positioning. Fast forward a few years, guess which stocks created more wealth? This is how the system actually works. Stocks don't grow because they're popular. They grow because expectations are wrong. Every stock price is a bet on the future, not today, not this quarter, but what the company will look like years from now. When expectations are too low, prices stay depressed. When reality improves faster than expectations, prices reprice violently. That's where setup for growth really comes from. Not hope, not vibes, math. Here's the simple mechanism. Institutions don't wait for good news. They wait for less bad news. A company doesn't need explosive earnings. It just needs earnings that are not as bad as feared. That's it. Imagine a business expected to grow at 2%, but quietly margins stabilize, debt stops rising, cash flow turns positive. Nothing dramatic happens, but suddenly that 2% expectation becomes 6, then 8, then analysts revise models, and the stock doesn't move linearly, it jumps. Because prices don't adjust smoothly, they gap. This is where the uncomfortable math comes in. A stock trading at a low multiple isn't cheap because it's bad. It's cheap because the market assumes something breaks. When that thing doesn't break, multiples expand. That expansion alone can double a stock even before real growth kicks in. This is why some of the biggest winners look boring at the start. No exciting story, no retail frenzy, no flashy CEO quotes, just quiet execution. Now, here's the irony. Most people say they want undervalued stocks, but when they see them, they say, "Why isn't this moving?" Because if it were moving, it wouldn't be undervalued. The hype comes after the setup. That's the part social media never shows. Instead, you get screenshots of gains with no timeline, no drawdowns, no boredom. But real growth setups are uncomfortable. They underperform. They look wrong. They test patience. And that's exactly why they work. Of course, not every quiet stock is a winner. Some are quiet because they deserve to be. This is where reality matters. Strong balance sheets, stable demand, pricing power hiding in plain sight. Industries that are hated but necessary. Not trends, not narratives, mechanics. Zoom out and you see the bigger risk. When money piles into the same obvious winners, returns shrink. Crowded trades don't fail loudly, they just stop working. Meanwhile, future returns quietly migrate elsewhere. That's how cycles rotate, not with crashes, with boredom. So the real question isn't which stocks will explode next. It's this: which companies are improving while expectations stay stuck in the past? Because that gap between perception and reality is where major growth is born. And the market won't announce when it closes, it just moves. By the time everyone agrees, the opportunity is already gone. So the uncomfortable thought to leave you with is this: what if the next big winners don't look exciting at all until it's too late to buy them cheaply?